Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Sonal Bhutra, and it's another quiet session for markets. At least the morning has been pretty much unchanged in the benchmark indices. Autos continue to struggle in trade. In fact, today as well, the Nifty Auto Index is down close to about 1.5%. IT Pharma too a bit on the back foot. On the way up, while the Nifty Bank is absolutely flat, you are seeing Nifty, the PSU Bank showing a little bit of a green. Metals are also higher in trade. But again, right, we're just talking about moves of about, 0.5, 1% here and there.
Oh, yes. And, we were expecting, or at least the GIFT Nifty suggested, a bigger cut that we could have seen in the markets today, but that hasn't happened. It's a 21-point cut, but yes, some of the sectoral movers which are making way today, as Reema pointed out, auto index continues to sulk. And remember, today it's Bajaj Auto's numbers as well. That was the top loser yesterday. And today, again, it is in focus. But other than that, we do have earnings reactions coming in. Today, the stock is in the green. But other than that, HDFC Life, that's the top Nifty gainer. We have HDFC Bank, which is lending some support to Bank Nifty. So Bank Nifty is the only index from the benchmarks which is in the green right now. Bank Nifty up around 23 points. The other gainers include the likes of Hindalco, there's Dr. Reddy's. SBI Life too is gaining in trade as we speak after a decent set of numbers coming in from HDFC Life. A lot of moving parts. We have the update coming in Hyundai IPO as well. The total subscription has been 0.22 times. Yesterday at around this time, it was around 0.1 times. It hasn't been that big a subscription so far, but the size also is very big.
Right?
Exactly.
When the size is so much, it's hard to, have those lofty...
Yes, and we are just used to those numbers now. I think for all the other smaller ones, you've seen subscriptions for more than 50, 60 times. And I think this number in front of that looks small, but of course, it's a huge IPO.
There's also another one coming up, Vari Energies, that opens up next week. And that's also looking to raise a sizable amount, not compared to Hyundai, but it's looking to raise about 4,300 crore rupees with a valuation of close to about 43,000 crore. We'll be talking more about it. But let's talk about Rallis. Good set of Q2 numbers.
And yes, and it has come in after a long time. This is one company which has been seeing declines for almost 6-7 quarters. And now we have seen an improvement that has come by. And that's the reason that why the street is so is cheering these numbers that we are seeing. So revenues, they increased by 11% on a YY basis. We saw an EBITDA growth of 24% to come in at 166 crore rupees. Profits were also up for the company to come in at 98 crore rupees. Both the segments have done well. If we talk about the crop care segment, the company says that's where the EBITDA was up 5% versus Q2 due to volume growth and better cost management. So the volume growth this time around in the domestic crop care business has come in at 17%, but there was a drop in pricing of around 11%. So the agrochemical industry continues to see pricing pressures. Export volumes were flat, but again, there was a decline in pricing, and that's why the overall export revenues declined by around 9% this time around. If we talk about their seeds business, that is where a strong growth has come by. 48% on a YY basis because of better Kharif liquidation. So this season has turned out very positive for the company. EBITDA also increased on the account of higher sales. There's higher operating leverage also. So both the segments have done really well. The seeds business especially, which has been under pressure. And that's why this stock is buzzing in trade. A 14% rally, and that is coming after a long time for this one.
But, it looks like the street was expecting, or, they believe that things have bottomed out, because this year the stock has given a 47% return.
Yeah, but that despite the fact that last few quarters haven't been
coming out with muted numbers, I think the narrative that things are going to get better, the worst perhaps is behind, has been playing out for a while now, because the stock has done pretty well. But let's talk about BSE, because that's clearly one of the stocks of the day, slipping after a Jefferies downgrade. Vamakshi joins in with the details on this. Vamakshi.
Well, yes, Reema, BSE under pressure today. Jefferies has gone ahead and downgraded the rating on this counter to underperform. However, they've gone ahead and raised their target price to 3,500 rupees per share. They say that the stock has seen a run-up of over 100% post the release of SEBI's new F&O framework. And this run-up that was seen was mainly on the expectation of market share gains for BSE at the cost of NSE. Now, they're assuming a 25% hit to the overall market volumes, and based on that, BSE's valuation is at a price to earnings ratio of 40 times FY26 estimates. This in turn implies that the market share rising from 13% in the second quarter to 30 to 35% with a 40 to 50% share in the weekly contracts. Jefferies highlights that this seems quite stretched, but they also highlight that this fails to capture risks from higher impact on overall market, lower spillover gains as well as further regulations. near-term risk reward, in their opinion, seems very unfavorable, and given those factors, they've gone ahead and downgraded their rating on BSE. Resultantly, the stock is declining in the trading session today.
Okay, all right. Thank you so much for joining us with all those details, Vamakshi. The other stock that I'm tracking today is AB Real Estate, because Nomura has initiated coverage on the stock with a buy rating and the target price of 3,700 rupees. They think there are three reasons why they like the stock. First is the long-term visibility because of development potential of 40-acre prime land that they have in Worli, and this could drive pre-sales of around 400 billion rupees. This is with 40% EBITDA margins over the lifetime of the commencement of projects as well. There's large-scale quality business development in Mumbai, NCR, Pune region, Bangalore as well that the company has. And as a part of the Aditya Birla Group, they talk about better management practices here, and that is something that could lead to them becoming a major player in the real estate market as well. They are pegging a gross development value of around 900 billion rupees going forward. The operating cash flow should be positive from FY25 in the real estate segment. It should be free cash flow positive from FY27, FY28 as well. Most of the projects are turning free cash positive from the start of the commencement as well. So that is something that they like, that the balance sheet is not stretched because of this gross development value that has come by as well. Between FY25 and FY27, they believe that business development will be largely financed by debt, and they expect the net debt to equity to come in at 1.1 times, but that would be a comfortable level considering that they are going through a big phase of business development. So they are quite positive, and the stock on the back of that is up around 7%. It opened higher, but still 7% is not a small pop that we're seeing on the stock.
Okay, and let's talk about HDFC Life. Today, it's the top Nifty gainer with the 2% rally. But remember, yesterday, HDFC Life was under pressure. In fact, one of the big Nifty losers after they came out with their Q2 numbers. Q2 numbers came out during market hours, and the key takeaway was that there was growth, but it came in at the expense of margins. So margins contracted for the company. The street didn't like it. The stock fell. But yesterday, there was an earnings call, which happened post-market hours, where the company has revised the growth outlook higher. So that's gotten the street excited. Now, we spoke to Vibha Padalkar, MD and CEO of the company. Listen in.
In the first half of the year, that growth on the upper end would be around 15%. We are revising it to say growth for the full year FY25 should be in the range of 18 to 20%. The reason why this gives me the confidence level is the first half of the year on a WRP basis, we grew very well at about like you said, 28%. APE basis, we grew by 31%. Whichever way you look at it, very good levels of growth. Beat both the industry, overall industry, and the private sector very, very comfortably. Market share expansion of 60 basis points. We achieved a watermark of 11% in terms of overall market share of the sector. 200 basis points differential is explained as follows. 100 basis points was simply because of product mix and largely because of unit linked, what we have been articulating. For example, in H1 last year, unit link was about 28%, and that increased quite significantly in H1 this year to about 36%. So largely due to unit linked and a little bit due to annuity.
Okay, get into a break. We'll come back and talk more earnings. The management of Nugent Software, again, came out with numbers yesterday. The stock was down 5%. Today, it's a bit flat. We'll talk with Virinder Jeet, the CEO of the company, on the other side.
Welcome back. You're still tuned into Trading Hour. It's time to talk about the commodity space. Manisha Gupta is joining in now, and today we are focusing on crude. A lot of movement here, Manisha.
Well, yes, Sonal, and some sanity really seems to be returning back into this contour right now. 0.5% of gains in the Asian markets, and this is after a 4% decline on Tuesday, 2% of decline on Monday as well. But 74 or thereabouts seems to be holding right now, and we are back by $1 in sense of the lows that the market hit yesterday. Well, this is because of some opportunity buying, some technical buying triggers as well that you have seen some buying come in. But apart from that, with the kind of cues that we are working with, it still seems under pressure. The high for this year for crude prices, by the way, is 91. So from there, we're trading at around 75, even with the bit of a gains that we are seeing right now. Well, to begin with, it is about weak global demand growth. OPEC and IEA both have suggested or revised their global demand outlook lower for this year and for 2025 as well. The second is that Israel has continued to reiterate that even as it will retaliate to Iran, but nuclear and oil facilities is not something that they're looking to strike on. The third thing really is about the dollar index itself, which has seen a bit of a decline coming into the markets. And then it also is about the Middle East. Markets are quite divided on where this quarter could really end by. If the tensions continue to ease, then you could be looking at crude oil prices perhaps breaking below 70. But if there is an impact on the crude oil facilities itself, then there are targets being put out from Bernstein, Bank of America, Citi even, that prices could go to 90, 95. There are three-digit conversations as well. So that's the kind of range that the global industry is working with for this quarter.
Thank you very much for that. Let's get to a corporate conversation then. It's Nugent Software, which reported a very steady set of Q2 numbers. The company's top-line growth came in at 23% on a year-on-year basis. On a year-on-year basis, we saw the margins also expand to 23%. To talk more about the quarter gone by and the second half of the year, Virender Jeet, CEO of Nugent Software Technology, now joins in. Thank you very much, sir, for joining in. This is Reema here. Now, in the first half of the year, you've clocked in a 24% revenue growth. H2 is typically much stronger than H1. So how is H2 likely to shape up for you? What are the key trends?
Good morning, Reema, and thank you for having me on your show. You're right. I think we have consistently grown on Y about 20% for now, almost last 10 quarters, and also with expanding margins. As you understand, the business is a product business, so margins do expand with the higher growth numbers. Our H2 revenues are generally stronger than H1 in terms of total value, which also puts more pressure on growth for H2 because the Q1, Q2 being on the smaller base, the growth rates could be higher. Having said that, we do expect to maintain the same growth momentum in H2 also. There's no reason. There's a strong funnel. Our traditional markets are doing very well, especially on the financial services, both in India, Middle East, and APAC. We continue to do well, and we don't see any challenge that we should not be able to sustain this growth.
So, Mr. Jeet, can we say that FY25 revenue growth would be 25 to 30%, anywhere between there?
No, I think we can't go there right now because, as I rightly said, we always try to project that we can sit somewhere between 20 to 25% of growth. And that's what we have been doing historically. And we base our assumption on that historical numbers. As I said, Q3, Q4 are larger quarters for us. And we expect to meet the goals of those on larger license deals. So there's a variability on that in terms of any kind of a change in that sometimes shifts the numbers. So I would still hope that we continue the current growth momentum for the whole year.
So guidance stays at 20 to 25% for the full year?
Yes.
Even though the funnel is very strong. Can you quantify how much better is the funnel today versus, say, 6 months ago?
So I think what we have pivoted, we have pivoted to slightly larger deals in all our geos. So in fact, the size of the funnel, number of opportunities may not be same, but we have on the value of the funnel, it has gone up by 30-35%. So we do expect that to translate in subsequent quarters into revenue for us.
Okay. In your press release also, you said that while banking and financial services continue to be your core verticals, you are seeing increasing traction in insurance and government segment in the quarter. Can you give us more details on this? How much contribution came in from here? Will this pie improve going forward? And will margins also improve if this pie becomes bigger? How does it differ from the other segments?
So if you look at the numbers, we predominantly are based on financial services where banking almost drives around 70% of the revenue. So sometime back, we really doubled down and tried to get our revenue share on both insurance and government. What we have done is we have invested in those. We have invested in both territories, building teams, refining products for that vertical. So the early green shoots of that have started happening. I think in this quarter, we had a significant deal on insurance at multiple in Middle East as well as in India. We also had a significant deal on government side out there. So it's showing returns. But for it to become substantial, I think we are expecting that both what you call government as well as insurance are able to almost contribute to 30-40% of our overall revenue in next 2 to 3 years. For that, they have to become much larger than the current numbers. But I do expect that this momentum to continue. While as the margin has no correlation with that, because margin is a function of what we sell, and we sell in both cases, we have a license-based business. So every deal has a healthy gross margin, and we should continue doing that.
So you want insurance and government to contribute 30 to 40% of your revenues in the next 2 to 3 years, right?
Yes. Yeah.
What is it in terms of revenue contribution today, and what was the growth seen in insurance and government in the quarter gone by?
So the bases are small. Right now, both combined is going to be more like 20% of our revenue, approximately that number. And I think this quarter, since there have been some deals in both the area, the growth rates of that will be substantial. They would be about 30-40% in these areas. But that's on a smaller base, so I think the percentage does not matter. But we do expect that we keep on building this, and through this we also accelerate the company's growth.
Okay. You know, while the growth has been broad-based, APAC in particular has done really well for you. Over 50% growth for 2 quarters in a row. Is this something which is sustainable? What's working there for you? And even in the US markets, what's the outlook? Because you have been focusing more on mature markets like US and Europe.
Yeah, you're right. So APAC, we started from a very low base last year. The last year, the deal closures in Q1 and Q2 was poor. So as a result, the H1 is looking much stronger in numbers. While I don't think a 50% number is what we are targeting, but I think since the base out there is small, it can grow at a faster speed. You're absolutely right. Our focus on mature markets is yet to really show results. What's happening, the traditional accounts which we have out there are showing business, and the current growth is more on, what you call the opportunities in existing accounts. But and our new logo acquisitions has not really kicked in. Having said that, I think in next 2 to 3 quarters, we should be able to see both momentum on the financial services, that is banking, insurance, and we also do as a segment as health insurance out there. All three should start kicking in and contributing to that revenue.
Mr. Jeet, we have more questions, but out of time. It's a busy earnings season. Thank you very much for joining in, and wish you all the very best. Get into a break. We'll come back and discuss market technicals. Mitesh Thakkar joins in on the other side. Welcome back. There is a dip in the markets. We were largely flat. Now we're down close to about 80 odd points, and some levels are being coming off from IT names. So pull up something like an HCL Tech that's dipped into the red. TCS is a cut of close to about 0.7%. So some profit booking is visible there. Tata Motors, Trent, Nestle are some of the other stocks where we've come off from the levels that we had about 10 minutes ago. All in all, not too much. It's just down close to about 80 odd points, but there is red on the screen. Mitesh is now with us for a quick tech check. Mitesh, your thoughts on the day so far and your top trading ideas?
Yeah. So, morning. See, I think the market still remain under pressure, and I've been, calling for some kind of contraction. I think that is what is going on. Today is basically on Monday we had a move, and then Tuesday and today I think is some kind of retracement. So it's still a market which is, contracting and getting into a range. In that sense, I think, we're not hitting the index. And on the stock side, I have a buy on Grasim. That's giving a good breakout on the hourly charts. So that could be some follow through here. Grasim, I would recommend buying with a stop at 27.40 for targets of 28.30. And Eicher Motors, that's a negative or a sell side kind of call. Keep a stop above 4,700, look for targets of 45.75.
All right. Thank you so much, Mitesh, for joining in as always and taking us through your technical picks. Time for a short break now. After technicals, we'll now discuss market fundamentals with Jyoti Vardhan Jaipuria, founder and MD of Valentis Advisors. Stay tuned. Welcome back. You're still tuned into Trading Hour. It's time to talk about market fundamentals now. Jyoti Vardhan Jaipuria, founder and MD of Valentis Advisors, is joining us now. Mr. Jaipuria, good morning. Thank you so much for joining in. Well, you're expecting lower returns to come by and lower earnings growth is expected in FY25 as well. Can you give us a sense of what is the Nifty earnings growth that you're expecting? And quarter two, how have you looked at it so far? I know not a lot of results have come out, but do you think this trend could continue going forward as well?
Yeah, so then, I think over the next 2 years, we'll probably end up with a very low double-digit sort of return, maybe 10 to 12% over the next 2 years. In fact, of them, this year is probably going to be a high single-digit return rather than a double-digit return because of the base impact. This quarter earnings, like if you look at a lot of the analyst forecasts which have come, everybody looking at between 5 to 7% sort of growth. So it's going to be a quarter which will be muted in terms of earnings growth. So far, of course, we've seen a very small sprinkling of results, and they've been, like I would say, on the whole, more or less in line with expectation. But, it's the very, very start of the season. So far, there are very few results which have really come out.
So you would be fully invested, Jyoti, because as you've pointed out in your recent note, that we are headed for the 9th consecutive year that the Nifty is given annual returns. Has that even happened before in the past? Shouldn't the law of averages at some point kick in and we see a bit of a correction?
Yeah, Rima, so this has never happened. The 9th year or the 8th year is like a record for us, whether we take the Nifty or we take the Sensex also, which has got a longer history. So it's been really, I would say, a very, very smooth market where, you made some returns every year. So then for people, the risk of equity goes away, because if you don't really see a meaningful negative return, you are like, okay, if I make 10% return every year, I make 5%, then it doesn't matter. So at some point, the law of average will catch up. I guess, even valuations the way they are, at some point, they're signaling that we'll probably have a weakish year for equities. But, frankly, if you think about it, most of us thought this year is the year where we'll not make too much returns in the market. When we started the year, we thought it could be a year of flattish to very low returns. It has turned out to be much, much better than what we thought. So I think partly it's because the economy is doing well, partly because the global markets are doing well. So keep our fingers crossed that bull times continue.
Okay, so tell us which are some of the sectors where you are looking for further correction, where you think there could be growth but valuations are stretched, or something that you think still is reasonable and you can put in some money there?
Sonal, there are lots of things where earnings growth is there, but the valuation are looking stretched. So one thing which we've been negative on, which a lot of other people like, has been the auto segment, where I think especially on the passenger car vehicle, we think growth will be very slow over the next few months. And, you've seen a very good rally in the share price there. Valuations are not cheap. So that's one thing which may struggle to give returns to the investors. The other is a sector which we like a lot, which is the capital goods sector. We've done very well with it because we had picked it up very early in the cycle. There again, valuations are starting to look stretched in some pockets. In fact, I think they're extreme. Like I would say, things like defense and railways, which are the market favorites, there the valuations are very, very extreme, even though the long-term prospects are good. But even within capital goods, we've trimmed some of our position, more because we think that at those valuations, the risk return is not that favorable. And so we've continued to be a little negative on it. What we've been nibbling on is actually the banks. So this is like a sector which now everybody loves to hate and nobody really owns it. Valuations, they are looking very cheap. So we've done an exercise where we looked at, let's say a 10-year PE average and the current PEs, or 10-year price to book and current price to book. And there are only two sectors which are actually trading at lower than 10-year averages. One is the banks and the second is the media. So these are the only two sectors trading below. So banks is some space where we've been nibbling a bit. There are going to be NIM pressures over the next 2 quarters, and especially once interest rate cuts start, you'll probably see the first impact of that will be negative on NIMs, and only after like 3-4 quarters NIMs start to increase. So there are negatives, but the valuations are so cheap that at some point, we think we'll make decent money on the banks.
So it's time to accumulate banks through this period of perhaps a little bit of bad news when the stock's correct due to the NIM compression. What about media? Are you buying media because valuations there are also attractive?
So, we actually have a media stock which we bought in the last 3 months. So that's like the first time we bought media in the last 4-5 years. So, in media, like I have a mixed view. The stock we bought is very, very cheap. It's like very, very cash surplus. At the same time, the business is not very promising to me in the sense, there are a lot of avenues opening up. So right from OTT to, the cable TV business is going down because a lot of the youngsters are preferring OTT. So the growth element is probably not very strong, but just the cash flows which we are getting and the free cash flow we have, we've taken a stake in a media company, basically.
All right. Okay. Thank you so much for joining in today with your take on what the markets would look like going forward, especially on the earnings and the valuation front, because it's a lot happening that we are tracking in the markets as well. With that, we'll slip into a short break. But as we do that, CNBC-TV18 celebrates 25 years of excellence. We invite you to the most anticipated event of the year, the CNBC-TV18 Global Leadership Summit, bringing together visionary policy makers, industry leaders, and trailblazing startup founders. This is where the roadmap for India's next 25 years of growth and global leadership will be charted. Don't miss your exclusive opportunity to be a part of the conversation that is shaping the future of business and innovation. Reserve your spot today.
Well, let's get to the earnings then. The big ones today, you've got Bajaj Auto in the auto pack in the large cap space. And then in IT, we've got LTTS and Emphasis. So we'll discuss all three of them. Let's kickstart with Bajaj Auto. Sudarshan joins in with the expectation. Sudarshan.
So Bajaj Auto will be reporting its Q2 FY25 earnings today post-market hours. First, talk about the stock performance in 2024. Stock has risen 70%, and in the last 2 years, stock has moved higher by more than 200%. Now, focusing on earnings, we are expecting strong earnings growth both sequentially and year-on-year, and revenue is likely to be aided by volume growth and better realization. Volumes in Q2 FY25 have increased 15% year-on-year and 10% sequentially. For margin, we might see an expansion on better net pricing, as some of the margin tailwinds are operating leverage and PLI benefits, and margin headwinds are higher aluminium price and higher two-wheeler electric vehicle sales. Watch out for the demand outlook for CNG and e-mobility sales. Now on to the main numbers. We are expecting an increase of 21% net profit. It might come at 2,228 crore. Revenue is seen rising 23% to 13,270 crore. EBITDA may increase by 27% to more than rupees 2,700 crore, and margin may expand by 60 bips to more than 20%. That is likely at 20.4%.
All right, we'll be watching out for that big number. Thank you so much, Sudarshan, for joining in with what to expect from Bajaj Auto. But a lot in the IT space as well, the mid-cap IT space. L&T Tech is the first one. What are we expecting, Reema?
Well, expect a strong quarter, a revenue growth of 4.5% on the top line. But this, remember, comes on the back of Q1, where revenues had fallen by 3.3%. So basically, revenues will bounce back after a weak Q1. Margins will expand owing to the large, the good growth in the top line. So margin expansion of close to 70 basis points, profit growth seen at about 7.5%. Now, amongst their verticals, mobility, that's basically automotive, did very well last quarter. We had about a 6.5% quarter-on-quarter revenue growth. This growth number may moderate, but mobility will still do very well. What we need to find out is the other verticals. For instance, industrial products, medical devices. Here, the management has been a bit cautious. Also, one more thing to watch is that their current margins, according to our poll, should come at 16.3%. Right? Last quarter, they were at 15.6%. But their aspiration was to get to margins of about 17-18% in the medium term. So how do you get to that, right? The levers, how soon? I think that's something the street will want to watch.
So management commentary for sure on that. But Emphasis as well, busy day again for you. Tell us more.
So expect a steady quarter, a fairly decent quarter. Remember, so this time we're expecting a revenue growth of about 1.5 to 2%. Growth for the company has been very muted for the last many quarters because of their exposure to BFSI. But this time, now expectation is things will start bouncing back. Margins are seen up 30 basis points. Profits are seen up 4.6%. Now, investors, though, are very optimistic going into Emphasis' numbers that things have bottomed out and there is a recovery underway. Since June, the stock is up nearly 30%. So the street is getting incrementally bullish because the last 2 years have been tough for Emphasis. So last year, revenues for the company declined by 6.3%. This year, things are likely to be, like a mid-single-digit kind of a revenue growth is what the street is anticipating. But the key is the recovery in BFS and BFSI. So BFS is 47% of their revenues, mortgage constitutes 6% of their revenues, and this segment is likely to benefit from falling interest rates in the US. So, they say, right, it's like a big V fall on the way down, and that's the way, growth should recover for Emphasis. Does that happen in this quarter? Is the management talking about it in the subsequent quarter? The stock is down, 30% since June.
Okay, so talking about V-fall, we are seeing a fall in the markets, a further pressure that has come by. Nifty is down 130 points right now. It is at the day's low. It's a cut of 165 points from the highs of the day. The mid caps are down further, 300 points gone there. The advanced decline ratio has worsened in favor of the declines right now. All the sectoral indices, they are in the red right now, barring Nifty Financial, and some of the stocks which are leading to these losses from the top. We have something like a Wipro, Tech Mahindra. These two stocks are at the day's low right now. Apollo Hospital, Britannia and ITC. So the Nifty IT pack and the Nifty FMCG pack, that is something which is leading to the pressures that we are seeing right now on the Nifty as well. Some other names which have a big weightage on Nifty and are leading to the losses, something like a TCS, Infosys. So we were talking about what to expect from the mid-cap IT space. The large-cap IT has come in under some bit of pressure. So watch out for the market moves, because there's been a sudden fall that we are seeing in last couple of trading minutes itself. For now, we'll slip into a short break. When we come back, we'll get to our special offering, FinStreet. On the other side, our colleague Abhishek will focus on the recent Q2 business updates from banks. Welcome back. You're still tuned into Trading Hour on CNBC-TV18. This is a special offering, FinStreet. Abhishek Kothari is putting focus on all the recent Q2 updates by banks and what are the trends looking like.
Well, 25 lenders have given the pro forma business update for Q2 FY25. Now, they form about 50.6% of the deposits in the system and 54.5% of the credit in the system. The trend is worrisome. Now, banks have seen high deposit growth on a sequential basis. The fight is on for deposits. Now, most of the growth in this deposit on a sequential basis has come in from high-cost bulk deposits, which are shorter tenure in nature and very costly as well. Hence, one can expect majority of the lenders to see pressure on their net interest margins. Now, CASA ratio continues its downward trajectory as seen in the last few quarters in the banking sector. Loan growth has remained tepid for many of them as the focus is clearly on lowering their credit deposit ratio. Let's take a look at the deposit growth on a year-on-year basis. Dhanlaxmi Bank, Indian Bank, South Indian Bank, J&K Bank, Bank of Baroda and Union Bank of India, all of them have seen single-digit deposit growth on a year-on-year basis. On the other hand, Utkarsh Small Finance Bank, Suryodaya Small Finance Bank, IDFC First Bank, Equitas, Bandhan, CSB Bank as well as RBL Bank, all of them have seen robust deposit growth of more than 20% on a year-on-year basis. So on a sequential basis, that is quarter-on-quarter, deposit growth has been weak for IDBI Bank, Federal Bank, Dhanlaxmi Bank, Union Bank of India as well as Indian Bank, all of them seeing less than 2% deposit growth on a sequential basis. While Suryodaya Small Finance Bank, Bank of India, HDFC Bank, Equitas, CSB Bank, RBL Bank, Bandhan Bank, Utkarsh Small Finance Bank have seen robust deposit growth of more than 5% on a quarter-on-quarter basis, and the best deposit growth has been for AU Small Finance Bank at more than 12%. Now, credit growth has been lower for many of them as the focus is on credit deposit ratio getting lowered. So, Yes Bank, J&K Bank, HDFC Bank, Union Bank have seen single-digit loan growth on a YOY basis, that is year-on-year basis. While Suryodaya Small Finance Bank, Utkarsh Small Finance Bank, Bandhan Bank and IDFC First Bank have seen robust loan growth on a year-on-year basis. On a sequential basis, that is quarter-on-quarter, loan growth has been tepid for J&K Bank, Ujjivan Small Finance Bank, HDFC Bank, RBL Bank, Utkarsh Small Finance Bank and Union Bank of India. Year-on-year, the loan growth has been the best for CSB Bank, Bank of India, IDFC First Bank, South Indian Bank as well. Lower loan growth than deposit growth has been seen for some players which has had an impact on the credit deposit ratio as well. Now, absence of deposit growth has meant an improvement in CD ratio or credit deposit ratio for IDBI Bank as well as Federal Bank. CD ratio has declined massively for Utkarsh Small Finance Bank, RBL Bank, HDFC Bank by almost 450 basis points sequentially, Ujjivan Small Finance Bank, Bandhan Bank and Equitas Small Finance Bank as well. So what are the key trends to watch out for? Now, the net interest margin will come under pressure for many of the lenders due to inflow of high-cost deposits and decline in CD ratio as well. Banks cannot grow their high-yielding unsecured segment growth, which can impact their net interest margin as well. Credit costs will rise due to pain in the unsecured lending that has been seen in the financial space. Other income will not be very high. Thus, there can be moderation in the return ratios, especially return on asset. This, in turn, may have an impact on valuation of some of the lenders as well.
Interesting. Thank you very much for that. The Nifty is at 24,950, now down more than 100 points. So after taking out 25,000, now 24,950 also gone. Sensex lower by 360 points. The top Nifty loser today is Trent. It's under pressure for the third day in a row. This week it's lost more than 5%. But remember, last week Trent was the top gainer as the company forayed into lab-grown diamonds and other beauty products. Titan too is, Titan in fact, pull up a one-month chart of Titan and you would see that the stock continues, has been struggling now. This month, it's down nearly about 10% Outside of, in the mid-cap space, Cochin Shipyard is a stock we've been highlighting. It's down close to about 4.5%. As the two-day offer for sale where the government is looking to sell about a 5% stake kicked off today. The floor price has been set at 1540. The stock is weak, but still holding on to that floor price. With that, it's a wrap on trading hours. Stay tuned. Halftime report is up next.